brand new construction. Renter time will be able to put everything together for you, right? So you're right there in the middle, the median range of the housing prices in the USA. You're in a growth market. It's an A-grade suburb of Birmingham, which is like a net population gaining market, right? It's a nice little tech sector, right?
You literally can buy properties, and we're going to walk you through how to do this. Brand new A construction properties with zero money down and possibly even get money back in your pocket. And I'll explain how that works.
Welcome to the Investment Properties for Sale Show, folks. Things selling at or above list. We are going to provide you guys with complete transparency and education. We take you to the video tour. HoltonWiseTV, giving it to you straight. All right, y'all, welcome to the show. Today, we're going down south. We're going to Birmingham, Alabama, the Birmingham market, all right? This one's coming to you guys from my friends over at Rent to Retirement, okay? Specifically, we're going to be in the suburb called Montevallo, all right? That's like, 15 minutes or so outside of Birmingham, right? So when you're thinking about this property, and the reason we go out to the suburbs, the reason they're going out to the suburbs is you get more bang for your buck, right? There's more underdeveloped land, right? So you get the same market, you get the tech hub, the southeastern tech hub that is the Birmingham market, but you get a little bigger bang for your buck when you're building properties, when you're doing communities, right? And that's why we're focusing on Montevallo. Just in Montevallo, we got that little university over there, but like the suburb itself is not the draw, right? The draw is the Birmingham market, one of the markets in the U.S. that these guys focus on heavily because they're able to pick stuff up for lower than the United States median average household price, right? Typically, the median, right? If you're an investor who's looking, on a national scale and you're looking for markets and stuff like that to invest in, right? You're looking for stuff, right? These guys don't want to be in the bottom of the barrel, right? Like I know there's a lot of investors out there who watch my show and y'all love that like super cheap stuff, right? Like the Section 8 stuff and some of the cheapest markets in the USA, right? Think about your markets like Detroit, Cleveland, right? Where you're buying stuff for like 50K, okay? That's one, real estate investment strategy, okay? Going for the super low Section 8 stuff, right? But a lot of other investors, right? You might want that really, really high-end stuff, okay? Right? You might want to buy properties in like Los Angeles, New York City, et cetera, et cetera. And then there's a lot of you that kind of focus in on like the median income, the median housing prices like of the country, right? Like you want to be right in the middle, right? And right in the middle in America, just so y'all know, these days it's about 400,000, right? What Rent to Retirement likes to do, they don't want to be on the high end. They don't want to be in California. They don't want to be in New York. And they don't want to be in the super low end space. They don't want to be in Detroit. They don't want to be in Cleveland. They want to be in markets that is around that median price point or a little bit under, right? In this case, the Birmingham market, where you could typically be about $100,000 under that median income, right? Hence the property I have for you today, right? This is the Poplar model. 301,900, right? You get 3 beds, 3 bathrooms. Technically, I believe it's a 2.5. I don't mess around with those 0.5s, dude. If there's a toilet in there, I'm counting it as a bathroom, right? Brand new construction home that these guys have got set up for you, right? High rents. What they focus, though, on is markets where you have the ability to raise those rents quite a bit, right? And that's what they think they're going to be able to do with this particular property. As a matter of fact, I'm going to have them get into that for you guys a little bit later. But this one, right now, $1,925 would be your starting rent. Again, I'm going to have Zach actually explain to you how you're going to get that rent up in the future, because there's a lot of good prospects that they have for that kind of thing. They have historical data on this kind of stuff. That's why you go to like certain markets that are like net population growth markets, like Birmingham is, okay? Anywho, as of now, though, 301,900, brand new construction. Renter time will be able to put everything together for you, right? So you're right there in the middle, the median range of the housing prices in the USA. You're in a growth market. It's an A-grade suburb of Birmingham, which is like a net population gaining market, right? It's a nice little tech sector, right? They call it the tech sector of the friggin' Southeast or some shit like that, okay? Again, it's like Silicon Valley, y'all. It's like Silicon Valley, except for like homeless people aren't just like pooping on the streets. You know what I'm saying? They got laws in Birmingham. All right, so it's a solid property, brand new construction. They're going to be able to put everything together for you, getting it built, getting it bought, helping you with the financing, helping you with the property management. And the cool thing is with the financing, they're able to set you guys up with no money down loans, okay? No money down loans. $0 out of your pocket. Now, that's kind of complicated how they do that, but they are able to do that. What I want to do now is I'm going to walk you guys through a lot of like complicated stuff, right? Zach, he's a smart dude. He's the CEO of Rent to Retirement, right? He's a former doctor, right? Friggin' eye doctor, you know? They say like, oh, you know, this shit's like not complicated. You don't got to be a fucking brain surgeon to understand it. Well, the guy's like, you know, pretty fucking close to being a brain surgeon, right? So he does go over a lot of complicated stuff. And I felt it would be easier to just have him explain a lot of the complicated stuff to you directly than me try to do it because, you know, I ain't a fucking eye doctor. You know what I'm saying? I will give you 30 different ways to evict a Section 8 tenant who doesn't want to pay their fucking rent to you. But when it gets into explaining hyper complicated stuff, such as like tax benefits, in relation to self-management, property management, accelerated depreciation, short-term management on yourself, becoming a qualified real estate professional, and or how to use creative financing to combine like investor funding with institutional discounts on new construction properties and builder concessions, right? You know, it's a little rocky for your boy Jay Wise, okay? You know, it's hard for me to put that into, you know, nice little nuggets that you guys can understand. But Zach, my friend, he does a pretty good job of that. So what I want to do is I'm going to shoot you guys a couple clips here from a webinar that I've gone over with him and stuff. And it's a lot of interesting stuff that will kind of really paint the picture of what it is they're trying to do and how they're able to put these investments together. The first clip that I want to give you is a little bit of his background. I think it's important if you guys are, you know, vetting him, thinking about buying a property from Rent to Retirement. I think it's important you know who you're dealing with, you know what his background is, right? So I want to have him explain to you guys directly just a little bit about himself. Then I'm going to have him get into the complicated way in which they're able to present you guys with no money down deals. Because honestly, guys, if people are out there touting no money down deals to you, oftentimes they're trying to like lure you into like a click funnel and a weird course. So like you should have like some red flags go up anytime a no money down deal is offered to you. Oftentimes there is like a major catch to it. Here, there isn't. But the way in which he does it is not just like a simple thing that anybody could replicate. So I want him to explain that to you directly. And then lastly, I'm going to have him explain to you guys exactly how they're going to set you up with property management if you want it. If you don't want it, I'm going to have him explain to you how you'd be able to do that without it. And then he'll get into some tax stuff, which, dude, to be honest with you, tax stuff, for a guy who's made as much money in this game as I have, I am not like super awesome on the tax stuff. Cool thing about being the co-owner of HoltonWise is I'm Wise. There's a guy named Holton. He handles all that behind the scenes stuff, so I don't really have to mess with it. But I will say, if I do have a weak point in this business, it is definitely the tax stuff, dude. When I talk to our CPA and they give me my tax returns and they're several hundred pages, I'm like, what? I'm like, I'm still fucking rich, right? And they're like, yeah, you're still fucking rich, James. Please go back on YouTube. And I'm like, okay, no fucking problem, right? That's how I handle my taxes. But like, you got to have somebody as part of your team that really is good at that stuff. Luckily for me at HoltonWise, I got Holton. For you guys, if you decide to go with Rent to Retirement, you got Zach to kind of show you the way on that. So I'm going to let him explain all of that stuff. And then after you guys watch that, have you guys encourage you to do a little more due diligence, do a little more digging on these guys. If you guys are interested in learning more or possibly buying the Poplar model down there in the Birmingham market, just reach out to them. Tyler should have the information on the screen right now. If he doesn't, it's going to be in the show notes below. I think this is a solid deal, and I think you're going to get a lot of knowledge about the business and putting these things together, right? We're kind of going to give you a little smorgasbord of info here that I think is very important for you guys moving forward.
I have a background in healthcare. My wife and I are both optometrists by education. I absolutely loved practicing optometry. I wasn't someone who disliked that. I'm an Air Force captain. I'm a vet now, but I practiced optometry for 7 years in the Air Force, and was commissioned as a captain there. That's where I started investing. I bought my first house, was duplex, lived in half, rented out the other half, and just fell in love with real estate. This is probably about 15 years ago at this point. There was a really a pivotal moment that changed the trajectory of my wife's, our family, and our trajectory for both business and just wealth in general. And that's where we started to invest out of state. I was stationed in North Dakota at the time, active duty Air Force. And we just thought, like, hey, there's got to be better markets out there than just North Dakota. Plus, we were not going to be there forever. So, we started looking at other areas where we could be successful investors and focusing on investing out of state. And it didn't always go well in the beginning, but that was really the birthplace and impetus for Rent to Retirement, which is the nation's leading turnkey real estate company at this point, especially in the build to rent new construction space. So essentially, this company was born because my wife and I were looking for a systematic way to vet markets, to vet teams in those areas, and to build really an approach to being successful investors across the country. And when we started to focus on markets where we saw the best inventory, the best cash flow, the best appreciation, we started to actually pay attention to markets around the country and data points. Our trajectory changed, and we were able to retire ourselves from our professional careers in optometry early in life. Now, fast forward to where we're at today, Rent to Retirement. I mean, you guys are familiar with kind of the turnkey concept, but what we define when we talk about a turnkey property is a property that's either been fully renovated or newly built. About 80% of what we focus on is new construction properties in growing markets that have the best combination of equity, cash flow, and appreciation. And it is quite possible to have all three of those while still investing in A-class areas where you get quality tenants and the homes will appreciate well over time, both in rents and home prices. But when we talk about a turnkey property, first we identify a market that has all the metrics you want to see: economic growth, population growth, diversity of industries, landlord-friendly legislation, low taxes. All these things are very important. And then we go into these markets and we build our local teams and systems in place to be able to access inventory for ourselves and our investors long term. And we have all the pieces in place that are going to help you be a successful investor, from property management, in lenders, specific lenders that we've negotiated special prices for you and offer unique loans, which we're going to talk about tonight. That's part of the reason you're able to get 0% down. And that's not just clickbait. You literally can buy properties, and we're going to walk you through how to do this. Brand new A construction properties with zero money down, and possibly even get money back in your pocket. And I'll explain how that works. But it's a really unique scenario where you can own quality assets and be a very savvy investor. As Adam and Naresh already know, and we didn't put this in the agenda, but I can't help but not talk about it because the time of year that we're in, being an efficient tax investor is extremely important. And we'll go through some interesting things that some of you may know about, or maybe this is the first time you've heard about it, but ways you can write off significant amount of taxes, both from your real estate and your active income, your W-2, whether you're a real estate professional or not. So if you have tax questions, throw those in the chat box. I love talking about tax stuff because our goal every single year, as just individually, my wife and I, is to buy enough real estate to offset our entire taxable income from business, from real estate, from active income, all the things. And we're able to do that every single year strategically. And I'd be glad to talk about some of that. I think it's really important that everyone take out pen and paper right now, because we don't have slides going through the math, but I'm just going to run through the math with you on this stuff. Okay. And I'm going to use simple math and keep it generally broad. But this is a combination of builder incentives and using unique loan structures. Let me set the foundation of like why we're able to access these type of deals and how our company works. So as Naresh said, Rent to Retirement, we form relationships all across the country in markets that we see opportunity in, to bring you the best opportunity regardless of your experience level and your geographic location. So anyone can invest in the best markets to be the most successful investor with all the teams set up in place. Our company really functions two ways. One, we do a lot of in-house new construction that we are personally building. But the majority of what we do, and Chris, I saw you on there. I still got some Cape Coral going there, buddy. So we'll get through it. But our company operates two ways, right? So we build our own stuff, but that's a small minority of what we do. The majority of what we do is actually forming relationships with regional and national builders throughout the country. And going to them and negotiating wholesale type of pricing, because as a community, we are purchasing hundreds and thousands of homes across the country. And so we are able to go to some of these national and regional builders and say, we're going to come in like an institution, like a BlackRock, and we're going to buy multiple houses, and we have to commit to that up front. And then we are able to, because of the buying power and the volume, have below market value pricing, wholesale pricing that we pass on to the individual investor. And we still put all the teams with management, lending, insurance, all the things in place. But our big value add, in addition to helping you build a strategy around investing to do things like maximizing tax benefits, is we are able to pass these wholesale type of pricings from these big builders like D.R. Horton, Toll Brothers, LGI, Lennar, that you would not have access to on your own because you're buying with our community. And we've already done all the research, right? These builders build all across the country, and we get to cherry pick the best inventory in the best markets and then offer wholesale type of pricing to the individual investor. So you don't have to be part of a big institution, right? And we are the first company to be able to do this. We are the first company to take the institutional type of discounts and deals and pass those on to the individual investor. And we're very excited about that. These homes are already completed. Some of them are already leased. Some of them are not leased. These are single family and some small multifamily in multiple different markets. So that's the business model that we operate. Now, how this works is that, we're negotiating these wholesale type of pricing from these builders. That can vary anywhere from generally 5 to 10% below market value pricing. That means on a $300,000 house, if there is a 10% discount on that house, that's $30,000. You could buy that house, and this is where the math is going to, if I would encourage you to write this and go through this with me so it makes sense and you have notes on this. On a $300,000 house, if we had a 10% discount on that, and again, it varies 5 to 10%, that means you have $30,000 that is immediately reduced. That builder would sell that retail for $300,000, and is today, that house will appraise at $300,000, but you're able to buy it for $270,000. Right? You get an immediate discount just by being a part of our community. Now, here's where it gets creative and gets better. And I'm going to cover a few of these other slides, but Naresh, stay on this one, I think. And then I'm sure that we'll have a ton of questions. So you have 10% on this $300,000 new construction house in an A-class area somewhere in the Southeast, because there's multiple inventory options and we just look at them with you, right? We have some that are significantly less than this and some that are more expensive. That $30,000, that 10%, you don't have to take as a price reduction. And we're the only people that have access to this exclusive inventory and offering this opportunity to you guys. This is really important stuff. That 10%, you as the investor get to choose how you want to use that. You can take that price reduction and have immediate equity. Guess what? That will help you burr the property. If you want to burr new construction, you can sell it and actually even probably make some money, because if agent commissions are 5% and you have 10% equity, you possibly could flip that and sell it on the retail market, although most people are looking to cash flow it and hold it. Or you could take that 10% and use it to buy the rate down. So you can buy the rate down into the 3s right now to cash flow the heck out of that on a 30-year fixed loan. Or you could take that 10% and put it back in your pocket, right? If you're putting 20% down on a new construction asset at $300,000, and that $60,000 is a 20% down payment using conventional financing, you can choose, if you want to get $30,000 back. Calculate what that does to your ROI. It skyrockets. All these are still cash flow deals. You have equity because you're putting 20% down, but we're giving you 10% back, right? That will cover half of your down payment. But you can do a combination of these things as well. You're the investor. It's your property. You get to choose how you want to use that 10%, but it's extremely beneficial. And not all properties are 10%. It varies on the market, anywhere from 5 to 10%. Some of the deals that we have that are 5% cash flow better and actually do better than the 10%. But this is where the 0% comes in, okay? And go through some questions, guys, if you have questions on this, because I'm happy to dive deeper into this. So we have 5 new construction inventory all across the country that you can get 5 to 10% discounts on, that you get to use. You don't have to use it as a discount. You can get cash back, buy the rate down, however you want to use it. Your money. And that's because we've negotiated with these national builders because of the volume and the relationship we built. We also have unique financing options that are available that we've also negotiated with different banks and credit unions. So you can use whatever lender you want to. Traditionally you need 20% down with a conventional lender to buy, but We also have local credit unions that will offer 5% down investor loans. And I know I'll get a ton of questions about this. I'm happy to go through this loan option. You still have to qualify for this loan. It's a portfolio loan, meaning these credit unions hold these loans in-house. They don't sell them. There's not Fannie Mae, Freddie Mac loans. You still have to qualify. You need to be, financeable and have good credit. But if you qualify, they will finance you up to 5 investment properties with only 5% down. There's no PMI, private mortgage insurance. There's no prepayment penalty. Remember, on a conventional loan, if you put less than 20% down, even for a primary residence, you have to pay mortgage insurance, PMI, right? We have lenders that will do 5% down on up to 5 investment properties. They don't lend in all states, but they lend in most of them. Now, here's how the 0% down works. And you don't have to do this, right? You can buy properties with 10, 20% down if that makes sense for you. We're here to help guide you through the right option. But if you're getting 5 to 10% back on a new construction property and you're using a portfolio loan from a local credit union, these are 30-year loans. They do have a 10-year term. And the interest rate's going to be higher than if you're putting 20% down. Just acknowledge that, there's probably 7 to 9% is the interest rate depending, because it's a bigger risk to the lender, right? As they have a higher loan to values, they're lending more money. It's more risk to them. So naturally, they have a higher interest rate. But if we're giving you 5 to 10% back on a new construction A-class property, and you're buying it with 5% down, then that 5% back to you, cash in the pocket, can cover your down payment, can cover your closing costs, and in some cases, even pay you to own a new construction property with 0 money down. So it's matching this unique 5% down loan option with a property that we're giving you 5 to 10% back on. And essentially, you're into the property for possibly no money down. And you're getting, in some cases, actually, paid to buy that property. Here's a caveat. Naresh mentioned this previously. If you have a 95% loan on a property, it not only does it have a higher interest rate, but it also has the loan payments just higher, right? Because you have a 95% loan instead of an 80% loan. So what that means is your loan payment's higher. You may not be positive cash flow on these deals. And you just need to evaluate that. This is where it ties into the tax side. And I can go off into a tangent here as well. I'll turn over to Naresh first. But we have a lot of people right now that we're working with. They just want to maximize tax benefits. They want to do the accelerated depreciation. They want to do the cost seg, where you can save up to 30% of the purchase price offset against your W-2 income. I will talk about that, but let me just cover the rest of this. And so, the property may not be positive cash flow if you have a 95% loan. Now, you don't have to put 5% down. You can put 7% down, 8% down to be able to have better cash flow. Or maybe you look at a Midwestern property that has a little bit better rent to price ratio and a little bit better cash flow, where you can still buy property with little to no money down, and you might have a positive cash flow or break even property here. But this can be carved out however you want it to be. It's a unique loan option matched with builder incentives that really provide a really unique opportunity for you to make big moves in your real estate portfolio. I think the one last thing I'll say, Naresh, is that understanding if you're going to buy this strategy or use this where you're, buying new construction, because you can buy up to 5 investment properties with this portfolio loan. So in theory, if you choose the right inventory, you could buy 5 new construction properties where you have no money really into the deals at the end of the day. That causes a huge tax benefit. You need to think about the exit strategy. Most of our investors are holding properties 4 to 6 years because the properties appreciate, the tenant's paying the loan down, just as Naresh talks about Keith's 5 ways you get paid. You're building equity over time. So maybe it makes sense if you do have a negatively cash flowing property within 3 to 4 years, cash out, refinance that property because you have equity in it, or just do a refinance and lower the interest rate, or put a conventional loan in place that has a significantly lower interest rate. So that's where most people are looking to use this strategy over the course of 3 to 6 years. Property management, turnkey in general, guys, we have property management teams that we vetted and likely personally used in all these locations. Most of them handle long-term rentals because that's what we focus on. That's your bread and butter real estate. So management is in place. They're hyper local to each location, and we vetted them, and they do a good job. You don't have to use them. Most people do because they're in place. But you can choose your own management team, or you can self-manage as well. The benefit with going potentially with one of our managerial teams, if you want to be more hands-off, if you're not local, and you don't want to self-manage, that's a great option. And same thing, we've negotiated lower fees because of the volume play with us, because we bring a lot of business. Typical standard management fee is 10% across the board. You'll often see 6 to 10% on management. And as you grow your portfolio, you know, you can even negotiate lower than that, even though we've already negotiated a lower than typical fee for you being part of our community. The part of the incentive, some of these builders are even paying for covering management for 1 to 3 years, as Naresh said in the beginning. So it's quite possible you could even have 0% management for 1 to 3 years, which is a really cool incentive. The management, how we select them, I won't go into that in detail for time purposes, but I will say that these are top performing managerial teams that perform well. They put, as Naresh put on here, their average rental increase year per year is 5 to 6%, which is double the national average. So Alabama, for example, their average is 6% per year. That means your rent is going up, your mortgage isn't going up, and likely your expenses aren't either, because on a new construction you should have very minimal expenses, but your rent is going up 6% on average per year. That means your cash flow is increasing year after year. Even with a negatively cash flowing property, there's a period of time where if you're doing 5% down, you may have negative cash flow, where you should be break even and then positive cash flow over like a 3 to 5 year period. How self-management works. So if you choose to self-manage, because you certainly can, whether it's a long-term rental or a short-term rental. What we work with investors on, for those that are not real estate professionals, meaning you don't have over 750 hours of real estate experience, you have a W-2 job that you earn majority of your income, you don't have a spouse that could possibly qualify as RE Pro, you say you're both working or not married. You know, if you can't qualify for real estate professional status for one reason or another, one way you still can take accelerated depreciation this year is by self-managing your short-term rental. That means you could buy a $300,000 property, you put some furnishing in it, which is an additional cost, but also additional tax benefit. And you're the one you have to do this yourself, but we have a cheat sheet for you. Like, here's your furnishing team. Here's your thing. Like, you just got to go through the steps of doing it. Here's how you list it on VRBO and Airbnb and all the things. We'll help you through that. But by self-managing, you can still take accelerated depreciation. If you've never bought a property before, you can be because it's considered in the eyes of the IRS as an active business. It really is. It's like hospitality versus a long-term rental. You can self-manage a short-term rental and still take the accelerated depreciation and offset it against your active income. So if this is your first property you've bought and you're going to self-manage for this year is the only year that matters, the year that you put it into service. So if you buy a $300,000 property and you self-manage it, and you have some short-term rental activity, that means you can do that accelerated depreciation. So again, on a $300,000 property, we usually see cost segregation studies come in around 30%. So 30% of $300,000 is $100K. I'm using rough math on this. This year we're at 60% bonus depreciation. Next year it goes to 40, and it's a step down until it's phased out. That's why it's important. Like, this year has better tax advantages than next year. It probably makes sense to buy now versus the beginning of the year, because you can count it against 2024 income. But on a $300,000 house, 30%, $100K, 60% bonus depreciation is $60K. That means if you buy a $300,000 property and you short-term manage it yourself this year, you could likely get around a $60,000 tax deduction this year, right? And that's against your active income. You earn $120,000, all of a sudden you've cut your tax bill in half just by buying through that. And again, if you buy that property with 5% down, where we cover the 5% for you or more, so you're into the property for zero money down, you literally can create a $60,000 tax deduction with no money down. That's how powerful this stuff is. But you have to own it this year. And if you don't want to self-manage it forever, you don't have to. The only year that matters that you self-manage is this year. Next year in 2025, January 1st, you can turn it over to property management and have them manage it. You can operate it as a long-term rental at that point in time. It doesn't matter. It's about the year that you put it into service.
Yeah, I also say they say you have to run it yourself. They don't say you have to run it well, right? And also, like Zach was saying, it's about buying it now whenever it's 60%. That does not mean, let's pretend that you don't want to do a short-term rental, but you're working your way up to being a real estate professional, and hey, in 3, 4, 5 years, I'm going to be a real estate professional. You can cost seg from the past. Like, I'm doing a cost seg this year on properties that I bought in 2019 and 2020. So I'm getting the 100%, or maybe it was 2020 and 2021, but I'm getting the 100% bonus depreciation this year because I bought it in a year where it was 100%. So
that's a gold nugget. If you guys have properties you currently own and you haven't done accelerated depreciation, like Adam said, it's a step down. Last year was at 80%. 2 years ago was at 100%. So if you bought a property 2 years ago and you haven't done accelerated depreciation, you can still do that. You can You can file it. You can run the cost seg this year, and you don't even have to do the cost seg. It has to be done before you file taxes. You turn it over to your CPA. But if you bought a property 2 years ago on that same $300,000 property, you get to take $100,000 deduction possibly instead of 60. But next year it goes to 40, and the year after that goes to 20. So that's why there's time sensitivity around making big tax impacts owning property this year. Again, it takes on average 45 to 60 days to go through and get pre-approved for the loan, to identify a property, to close it.
Thanks for watching. Subscribe to HoltonWiseTV for more financial information, education, and entertainment.